Between April 1991 and April 1992, the Indian stock market went on an absolute tear. In exactly 1 year, the Sensex skyrocketed from 1,200 points to 4,400 points, a nearly 400% return. This massive surge was driven by a flood of cash pouring into the market, but financial experts were completely baffled. Nobody could figure out exactly where all this new money was coming from or who was putting it there. Enter Harshad Mehta. He was a stockbroker known on the floor as the Big Bull. If Mehta started buying a company's stock, its price would shoot up almost overnight. But Mehta was just a middleman. He facilitated trades for other people. So how did a broker find the capital to single-handedly pump thousands of crores into the market without risking his own personal wealth? To find the answer, we have to look past Wall Street-style trading algorithms and examine the actual paper trail of 1990s India. Let's look at the banking ecosystem at the time. The Reserve Bank of India enforced strict regulations on commercial banks, forcing them to hold a specific percentage of their deposits in cash and government securities. This created a daily imbalance. Some banks ended up with extra cash but not enough securities, while others had excess securities but were short on cash. They solved this by using ready-forward deals. A cash-rich bank would lend money to a cash-poor bank for a short period, usually around 15 days. In a standard ready-forward deal, the borrowing bank would temporarily hand over government securities to the lending bank as collateral. Once the 15 days were up and the loan was repaid with interest, the securities were returned. In theory, this worked perfectly. In reality, it was 1991. The financial system was almost entirely analog. Physically carrying stacks of highly valuable paper securities across Mumbai traffic for a simple 2-week loan was a logistical nightmare. To save time, banks adopted a shortcut. Instead of moving physical assets, the borrowing bank simply issued a bank receipt, or BR. This was a paper IOU, a written promise stating the government securities were safely locked in their vaults and belonged to the lender. By swapping out physical assets for paper receipts, the Indian banking system moved from trading hard collateral to trading on blind trust. To make these ready-forward deals happen, banks used money market brokers to find willing partners. Harshad Mehta was one of those brokers, which put him right in the middle of multi-crore cash flows. Mehta recognized a massive flaw in the paperwork. He convinced the lending banks to write the loan checks directly to him rather than the borrowing bank, promising to deliver the bank receipt in a few days. Looking at the chart, we see Mehta's strategy. He took the bank's cash and diverted it into the stock market. By buying his favorite stocks, he inflated their prices, sold the shares for massive profits, and finally completed the transaction with the borrowing bank. But the stock market is a hungry machine. To maintain those artificially high share prices, Mehta needed a constantly growing pool of capital. A simple 15-day delay on a bank transfer was no longer enough to keep the scheme alive. So Mehta escalated his operation. He struck deals with executives at small, obscure institutions, like the Bank of Karad. In exchange for bribes, these banks printed fake bank receipts. These receipts looked official, but they were backed by absolutely zero real government securities. With these counterfeit receipts in hand, Mehta effectively secured a blank checkbook. He handed the fake IOUs over to India's largest financial institutions, like the State Bank of India, and drained billions directly from their reserves. That spectacular 1992 bull market was an illusion. It was entirely fueled by counterfeit paper and a banking sector that completely failed to verify the assets it was supposedly buying. The scheme eventually buckled under its own weight. The Reserve Bank of India noticed a highly suspicious volume of bank receipts circulating in the money market. At the same time, executives at the State Bank of India audited their books and discovered a gaping 500 crore rupee hole. On April 23, 1992, financial journalist Sucheta Dalal published a front-page story exposing the missing 500 crores. She explicitly named Harshad Mehta as the mastermind behind the missing funds. The moment the news broke, panic swept through the exchange. The stock market crashed instantly, wiping out the life savings of countless retail investors. By the time investigators finished their audit, the total scale of the fraud hit 4,000 crores, nearly 25,000 crores in today's money. Mehta was quickly arrested and his assets were seized. The small, corrupt banks that had printed his fake bank receipts completely collapsed and were forced into liquidation. During the subsequent investigations, the government realized the core issue. The physical, paper-based trading floors of the Bombay Stock Exchange were inherently unsecure and too easily manipulated by individuals. To prevent this from ever happening again, India built the National Stock Exchange. This was a fully electronic, screen-based platform designed to make every single trade transparent and eliminate the human loopholes of the past. Harshad Mehta pulled off India's most devastating financial heist by exploiting the blind spots of an analog system. But the fallout from his crimes directly forced the creation of the secure digital infrastructure that protects the country's markets today.